Welcome to Daybreak Asia. We're counting down to Asia's major market opens.
The top stories this hour. Traders are holding back from big bets ahead of those US CPI numbers, and central bank decisions set to test hopes that rate cuts are on the horizon. Bank of Japan insiders tell Bloomberg that officials see little need to rush into ending the world's last negative interest rate at next week's meeting. Plus, President Xi and China's top leaders reportedly begin their annual economic conference to set the country's 2024 growth target.
Take a look at how U.S. futures are coming online in the Asian session. We're seeing a little bit of downside after U.S. stocks marginally rose in the New York session. There was really cautious trading ahead of a busy week of central bank decisions and key data as well. We had the S&P 500 holding above that 4,600 level. The Nasdaq 100, in fact, outperformed. We saw a rally in chip makers. Investors were also digesting more data from the New York Fed survey showing that consumers' near-term inflation expectations dropped to the lowest since 2021. This coming ahead, of course, of CPI data on Tuesday and the FOMC decision on Wednesday, the last of the year. Treasuries were a little bit mixed, mostly fell, led by longer end. The 10-year yield slightly higher to that 423 level. And we continue to watch oil prices. WTI seeing a little bit of upside and extending those gains that we saw in the New York session, really steadying after 7 weeks of losses already. We're headed towards more reports coming from OPEC and the IEA as well. These are some of the big movers in the after-hour session. Take a look at this pressure on Oracle, which has just reported disappointing sales. They're seeing slowing cloud momentum, revenue gaining only 25% after a 30% jump in the previous quarter. We are also looking at Hasbro because they announced the elimination of 900 positions. They had an additional strategic review. Remember, in January, they had already said that they would be eliminating 1,000 positions globally. So its peer Mattel is also falling. Ford, though, gaining a little bit of ground. They're cutting in half the planned production of the electric F-150 Lightning pickup. And this, of course, coming at a time of that industry-wide pullback in EV investments, Heidi.
Yeah, take a look, Shery, at how we're setting up as we get into just the start of cash trading here in Sydney. Of course, we also just have been listening to Governor Michelle Bullock speaking at a payments summit here in Sydney this morning, talking a little bit in that Q&A about the balance between inflation and keeping the job market steady, saying, really acknowledging it's been a hard year dealing with inflation and interest rate rises. She says she hopes things will get better in 2024. And I know a lot of people, particularly those struggling with the cost of living crisis, and at this point in the rate cycle will be hoping the same. Michelle Bullock saying that she does think that we can cool inflation while keeping those job gains, and doesn't think that the RBA is behind when it comes to that global CPI flight. A little bit of commentary sort of around tokenized assets and some of the reviews that the RBA is looking to take around the payments and buy now, pay later space as well. So some of those sectors will certainly be in watch. Pretty flat start to trading here in Sydney at the moment. We're not seeing much of a move in that staggered start to trading. Also, really no moves when it comes to Australian bonds either. Of course, a lot of sidelining going on ahead of the Fed. Investors overnight also shying away from that 3-month bill auction as well for Treasuries. Yields had been climbing, but was not seeing much of a move in Australia or New Zealand. The Aussie dollar is holding pretty steady. 65, 66 is where we're at for trading in the Aussie. We'll be watching, of course, very keenly what we see out of that Central Economic Work Conference in Beijing, what Chinese leaders will be setting up for their macro priorities, specifically the signalling behind that GDP target for 2024, right? Whether that's going to suggest that more of a fiscal push is going to happen. The other thing, of course, we're watching is the BOJ and these oscillating, I should say, expectations in terms of what they may or may not do starting from that meeting next week. Officials seeing little need to rush into scrapping the world's last negative rate this month. They see potentially enough evidence of wage growth that would support sustainable inflation when they meet next week. That's the latest that we're hearing. But let's get the views from our senior markets editor and Bloomberg opinion columnist. John Authors joins us now. And John, I know that you've been writing and also sort of opining about this at length in terms of, are they ready? And they have obviously been, preparing the markets and preparing investors. Could they potentially wait a little bit longer?
Well, it sounds as though from the latest briefing our reporters have had, it sounds as though they do want to wait somewhat longer. I think in the very long term, the direction of travel is clear. And it would only be in the result of a very serious disappointment for the Japanese economy in the next few months if we don't see rates actually turning positive at some point next year. As you were saying, I think the critical point here is the wage negotiation, which in Japan is generally front-loaded to the beginning of the year. If you have, the last I saw, the real wages in Japan were actually falling, i.e. that the rebound in inflation hasn't sparked any particular rebound in workers' enthusiasm for bidding up their wages. If you do see some further rise in wages, I think that would be the final signal that the BOJ needs. If you don't, that would suggest Japanification really is profound, and it would make it quite difficult for them to hike rates. So I suspect that the wage negotiations are going to be particularly critical.
John, as we wait for more clarity coming from the BOJ, what does all of this mean for the Japanese yen? I mean, last week we heard from people saying that it was really too tricky to trade the yen. We have seen that incredible strength and then incredible weakness this week. What are the implications for the currency?
Well, the implications for the longer term are that it's going to get stronger. And that, broadly speaking, is what Japan could probably do with. The level of the dropping beyond 150 and not getting an intervention to bring it back was quite surprising. It does show that the yen is at an extremely weak, over-competitive level, and I think the odds, I've been reading notes with previews for next year where people are talking about 120 for the yen or 110. That's a big shift from where we are now, but it would appear to be justified if you think rates are coming down in the US and Europe, and they will go up at least a little bit in Japan. Then that really does tilt the equation much more towards bringing money back if you're in Japan. I think the fact that the yen is so overextended, that there's so much money out there in carry trades, that so many Japanese retail investors, the famous Mrs. Watanabes, have effectively bet on a continuing weak yen by putting money outside the country. I think that is a big factor in the BOJ trying not to let this happen too quickly. It wants people to have the chance to adjust and repatriate steadily rather than seeing a sharp vertical line on a currency chart.
Our senior markets editor and Bloomberg opinion columnist John Authers there. And our next guest says that the BOJ policy decision next week is live on a potential tweak to the yield curve control policy. Joining us now is Gary Schlossberg, global strategist at Wells Fargo Investment Institute. Gary, great to have you with us. I mean, we have been surprised by the BOJ so many times in the past, even this time around in July and last December as well. So what should we be watching out for in this policy decision?
Well, I think as mentioned just a moment ago, the wage outlook is certainly important. I think that live meeting has become a little less so in the last couple of days following comments by the Bank of Japan's governor about the wage outlook, being comfortable with it, the fact that real wages are declining. The Japanese have a little room to maneuver, a little bit more room to maneuver, given the slowing or the growing prospects of rate cuts or expectations of rate cuts here in the U.S. Whether or not that transpires remains to be seen. But that priced into the market, I think, gives the Bank of Japan a little more leeway to wait before making any significant changes to the yield curve management policy that's been in effect.
How much of the yen's trajectory will depend on what the Fed and Chair Powell say this week?
Well, I think it will be a mover if the U.S. the Federal Reserve keeps its powder dry, keeps monetary policy unchanged, I think that acts as a restraint on any yen rally going forward. We did see the yen improve a bit on expectations that the Federal Reserve might be cutting rates multiple times sooner than later. If that view begins to change, then I think the Japanese yen's recovery could be delayed a bit as the market looks ahead to the wage negotiations and what effect that might have on Bank of Japan policy.
And Gary, when it comes to the Fed, what are you expecting in terms of this week's meeting and the dovish pivot that has been really priced into the markets for next year?
Well, we don't expect to see the Federal Reserve moving to cut rates at this meeting. We think policy will remain unchanged. It's really the commentary accompanying that decision that will be the focus of the market. If the Fed, in fact, hints at a rate cut sometime during the early part of next year, that would be tantamount to an easing. I think the market risk assets would respond well to that. The fact is that the U.S. economy is losing momentum, but complicating things is the fact that a recession still is something of a question mark. We still could be going through a soft landing. And if that's the case, then the Federal Reserve, I think, is on hold for quite some time.
Given the optimism in the markets, how much would you say that a potential earnings challenge ahead is priced in? And what are the risks stemming from the fact that the monetary policy drag could be bigger going into next year?
Well, I think policy drag could very well be there if the Fed is on hold as expectations adjust to that. The bigger hurdle we continue to believe for the market is the possibility of a slowdown in the economy during the early part of the year, producing more sober earnings expectations by the market. We really haven't seen that in a big way. The market, we feel, is still pretty optimistic on the earnings outlook for 2024, given what we believe to be a slowdown during the early part of the year. And that could be the biggest hurdle for the stock market over the next several months.
So how are you positioning your portfolio in terms of risks, especially when you're looking at, say, large caps versus small caps, developed markets over emerging markets?
Well, we're staying with our strategy that we've had in place for quite some time. We continue to favor the U.S. market over markets overseas. That could change as we pull through a slowdown and begin to emerge from that, we and the global economy. But for now, at least, the focus is on the U.S., the focus is on quality, healthy balance sheets, resilience of earnings to a slowdown, typically larger cap stocks. By sector, we're focused on healthcare, which is defensive. We also are favorably viewed toward raw materials, the materials sector, and industrials. These are economically sensitive sectors of the economy, but we think the fundamentals there are strong enough to weather the kind of moderate slowdown that we're expecting and continue to hold up well during that period based on the fundamentals out there.
Gary Schlossberg, always good to have you with us, global strategist at the Wells Fargo Investment Institute. And coming up, a draft deal at COP28 coming under fire from some countries. We'll discuss the implications with the Voluntary Carbon Markets Integrity Initiative later this hour. But first, China's annual Economic Work Conference is reportedly underway with 2024's growth target in focus. We'll get the details. This is Bloomberg.
Chinese President Xi Jinping and other top leaders have reportedly begun their annual economic work conference that will set the nation's policy agenda for 2024, and expectations are running high for an ambitious growth goal to shore up investor confidence. Our Greater China Senior Executive Editor John Liu joins us now from Beijing, and we know that this is sort of, a pretty mysterious but closely watched process, and depending on what we get, it could potentially signal the willingness for fiscal and monetary policy support in 2024.
So the thing that these leaders will do during this meeting is set a growth target for 2024. That will be really important in terms of just setting a tone for the overall economy. If they come out of that meeting with a 5% target, similar to what we had for this year, that would be a more ambitious target because the base of comparison is going to be greater in 2023 than it was in 2022. And that would signify an ambition. It would signal to the rest of the bureaucracy that the central government, Beijing, wants everybody to do as much as they can to get the economy growing again. It would prevent the sort of vicious cycle where bad economic data leads to lower economic targets, leads to even worse economic data.
And, technological decoupling obviously is just one of the many headwinds facing the Chinese economy. And we heard from the Commerce Secretary that the US is looking into the specifics of not just Huawei's chip breakthrough that we've been talking about at length, but also, these 3 new artificial intelligence accelerators developed by NVIDIA for China.
That's what we understand from Commerce Secretary Gina Raimondo, that they are looking into these 3 chips that NVIDIA is designing specifically to sell to China. They announced that in November after an earlier chip they were planning to, or had actually made substantial sales to China already, was banned under new U.S. sanctions that were imposed to limit Chinese access to the most cutting-edge technologies in the semiconductor space. Companies are running into this issue, various American companies, Taiwanese as well, and they're trying to find ways around it, but having to work with governments to do that.
It's interesting, NVIDIA seeing Vietnam as a potential second home, according to some of these latest reports. And we know that President Xi is due to land in Hanoi as well. Really, it's very interesting because we've seen this kind of latest in a string of charm offensives, right? What is he hoping to achieve with communist Vietnam?
Well, I think it's very notable to point out that President Joe Biden visited Vietnam just a couple of months earlier. And so you have a country in Southeast Asia which is sort of trying to strike this balance between the United States and China. China is Vietnam's largest trading partner, but at the same time, Vietnam and China have a rocky relationship. They have competing claims in the South China Sea. They fought a war in the late 1970s. And so Vietnam has tried to use the United States as a counterbalance to China's military and economic weight on this continent. And so Xi Jinping coming to Vietnam, trying to make sure that Vietnam is not moving too close to Washington as China's trying to keep its trade relationships open, its economic relationships open, and also maintain a security situation here in Asia.
Our Greater China Senior Executive Editor John Liu there. And sticking with China, and the country has launched an investigation into the potential security risks related to geographical information going overseas. An article published on a state social media account says software used in important industries has been collecting and sending such data overseas. It says some of the information includes state secrets related to pipeline networks and military facilities. You can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can find that at Daybreak Go. It's also available on the mobile in the Bloomberg Anywhere app. You can customize those settings so you just get the news on the industries and assets that you care about. This is Bloomberg.
watching Daybreak Asia, the top corporate stories that we're tracking this hour. Microsoft is teaming up with labor unions to create an open dialogue on how AI will impact workers. Under the partnership, the tech giant will provide training on how artificial intelligence works and gather feedback from certain sectors. This marks the first formal collaboration on AI between the tech industry and unions amid concerns it could displace workers. Bloomberg has learned that Macy's received a nearly $6 billion buyout offer from Ark House Management and Brigade Capital Management. Sources say investors offered $21 a share for the retailer. The offer comes as Macy's readies for a changing of the guard, with CEO Jeff Gennette retiring in February. Retailers have lagged the overall rally in U.S. stocks this year, in part due to higher interest rates. Bloomberg has learned that Bank of America has promoted 334 of its employees to managing director, 8% fewer than last year's total. One source says for the fourth year in a row, more than half of those elevated to the senior role are women or people of color. Wall Street banks have pledged to improve diversity as competition for top talent heats up across the industry. Steve Cohen's Point72 Asset Management is bulking up its macro trading teams. The company says the unit will soon have 51 such teams, with 2 new hires joining next year. That's 5 times the size from 3 years ago, and comes as Point72 diversifies its $31 billion hedge fund business. Morgan Stanley chief U.S. equity strategist and CIO Mike Wilson saying that the U.S. company earnings are likely to weaken in the fourth quarter before rebounding next year. He spoke with Bloomberg's Lisa Abramowitz on his stock predictions for 2024.
It's really more about the stock picking, which is really what this year has been about too. The average stock has not done particularly well. It's kind of been a strange year in that regard. Our earnings forecast for the average stock has turned out to be, dead right, and same thing for the average stock. And then we've had these, 10 or 20 or 30 stocks which have done extremely well, and they've done an incredible job of cost cutting in particular, which has driven the major average, the S&P 500 earnings up in a way that we did not project. And that has been the difference. And we think that that dynamic will probably persist next year, at least for the first 2 quarters, meaning smaller, lower quality businesses are going to continue to struggle. And then maybe by the second half of next year, when we see actually inflation bottom, ironically, that's when the earnings will come back. And I think that's been the trick. I mean, if you think about this year, inflation's been coming down, which usually is unequivocally good for bond yields. It's also good for disinflationary assets. It's not good for inflationary assets, which are basically small cap stocks and generally average stock. The average stock does better when inflation is actually accelerating. And I think that's been the trick this year. And most people got it wrong, quite frankly, because there were many, many people recommending, small cap stocks and financials and cyclical stocks, and this just don't work when inflation's coming down.
Mike, what you outlined, though, raises a question about the 4,500 target on the S&P at the end of next year. Is that assuming the big tech can't keep leading, that essentially there might be a recovery of some of the other stocks, the smaller caps, but that there will be at least some stasis for the big tech names that account for the lion's share of a lot of indexes?
Well, that's right. I mean, basically, this year has been all about multiple expansion, and this is in a year also when rates have gone up for most of the year until recently. So that's a combination that is unusual, as you know. So, our call at the beginning of this year was that rates were going to rates had normalized, quite frankly. They were going to continue to normalize, and then therefore multiples should normalize. So the real difference between our price target this year and what's transpired has been all multiple. We thought the market would close the year at 17 times earnings, which seems to be a fair multiple in an environment with 10-year yields north of 4% and some sort of level of risk premium. But instead, multiples are 19 and a half times. So all we're saying, Lisa, is that multiples will adjust this year. Earnings will be fine still for those large cap companies, but the multiple offset probably has them churning in place. And there will be some, obviously, that can continue to deliver better earnings growth, but it won't be all of them. It won't be as broad because that cost-cutting story isn't going to be as easy given the tougher comparisons on that front in 2024.
We do have Westpac consumer confidence for Australia just crossing the Bloomberg there. We are seeing the seasonally adjusted month-on-month number for December coming in at 2.7%, so reversing the earlier contraction in the previous month of 2.6%. The December reading headline number is 82.1, so really climbing from the 79.9 that we saw in the previous reading there as well. Expectations saw an improvement of almost 4% month-on-month. Current conditions seeing a little bit of a tick up. When it comes to family finances or household finances, also seeing an improvement of almost 6% month-on-month, and even a little bit of a gain versus a year ahead there as well. Expectations for the economy 1 year ahead seeing a fall of 2.2%, but 5 years ahead seeing a gain of 9.7%. The purchase of major household items, though, falling 3.8% there. This, as we see consumer confidence just edging up in December after the RBA resumed their rate pause, but still holding pretty deep in pessimistic territory there, Shery.
And Heidi, take a look at the broader markets because you can see the Aussie dollar under a little bit of pressure right now. We have seen that pressure given the weaker Chinese data that we've seen, the weaker yuan as well, not to mention lower metal prices this week. And you can see the ASX 200 up 0.1%, but really not doing much at the moment, with Kiwi stocks also declining for a third consecutive session. And we're setting up for the Japanese session with Nikkei futures up 0.8%, and really not a lot of movement in U.S. futures either, Heidi.
Well, of course, investors looking ahead to key central bank decisions, and it is that expectation to pivot to easier monetary policy next year after the most aggressive rate hikes in decades. But for some economies and businesses, that change can't come soon enough. They're reeling from the impact of elevated borrowing costs. Let's discuss all of this with our chief rates correspondent for Asia and live contributor Garfield Reynolds. Businesses, households, and certain economies really would be looking for this to happen sooner rather than later.
Yeah, I mean, there's always been this tension, even as economies and spending were remaining resilient, like the savings pool from the COVID era. There's also the worry that part of what helped build up that savings pool was during the COVID era, interest rates were at record lows. People and businesses did a lot of borrowing to try and lock in those low costs. Now, every month we head forward with interest rates at the sort of elevated levels they are is a month where businesses and households face the need to refinance borrowings that they made when rates were a lot lower now than they are now. And the gap between what businesses, for example, are paying based on Bloomberg indexes and what the current market yields are, which is what you would expect they're going to have to pay something like that in order to refinance, is the widest, around the widest it's been on record. It's come in a little bit with the rally in the last couple of months in the global bond market, but it's still huge. And that's why a lot of economists and businesses are a lot more concerned about the idea that central banks need to crack on and move to cut rates than central banks themselves are. The central banks are sort of sitting back saying, well, yes, inflation's slowing, it's not slow enough yet. Others are saying, look, there's a ticking time bomb under the economy. So you need to cut rates proactively, otherwise you're going to get a sudden major hit to the economy right when it's already weakening, and then this is going to keep on coming through. This is the danger of those monetary policy lags that everybody talks about, but all too often the concern is that central banks and others don't take them fully enough into account, because while they can talk about the lags, until they see the impact, they won't move.
So how precarious is the situation for corporate America if you take a look at the amount of the debt that's maturing soon?
Yeah, that's one of the big concerns, because there are there's a lot of debt that's maturing. Not so much in the first half, more towards the back end. And part of what happened too, which they're trying to reverse, was that a lot of companies went shortened the duration of their exposures, because that was where the cheapest money was available. There was also that uncertainty when you're in the midst of the pandemic. It's like, well, it looks like things are going well now, but we're not sure how much longer that will go on for. We're not sure how much longer the government and central bank largesse will be there for us. So it made sense to borrow a lot. It made sense to borrow on a shorter time frame that might otherwise have been wise. So that adds to the dangers as you're going forward.
Our chief rates correspondent for Asia and MLive contributor Garfield Reynolds, as we keep an eye on, of course, the health of the global economy. We're now hearing that a UN agency has seen global trade declining in 2023 by about 5% from last year's record. According to the Conference on Trade and Development, that's in part due to high borrowing costs, inflation, and also U.S.-China tensions. The agency estimates the goods trade will hit $30.7 trillion this year, compared with $32.2 trillion in 2022. It also noted geopolitical allies tended to trade more with each other. Let's now turn to the outlook on business deals. Citi's Institutional Clients Group chairman says the environment for M&A should start to get better in 2024 after a very muted year. Leon Cavaria told us more about the state of investor appetite for deals.
The investor appetite is there, absolutely. They want to see the strategic rationale. They want to understand the time frame to close from a regulatory standpoint, because obviously if it takes 2 years, they have to factor that in from a present value standpoint. And then they want to see what the value enhancement is. So the investor reaction, I think, will continue to be something that everyone focuses in on. But so far, strategic transactions have done fine. And the issue has simply been long-term regulatory impact and how long will it take and what will be the legal issues to get from here to there. That's unchanged.
What about industry here? Because the other big elephant in the room we have not talked about is Occidental, Crown Rock, $10.8 billion deal. You're starting to watch mega deals back in the market. 2 of the top 3 deals this year so far have been mega deals in the energy industry.
Correct.
Is that what's going to drive M&A into 2024?
Well, I think the environment for M&A should start to get better here. We've obviously had a very muted year. It's been muted because of the uncertainty on the economy, uncertainty on interest rates, and uncertainty from a regulatory standpoint. Those hurdles are starting to go away. But, you still have a 10-year that has not yet gone down. It's not broken 4%. So financing remains somewhat expensive if people have to do it. But on the other hand, the equity markets, from my standpoint, are at highs. So the use of equity becomes very, very attractive. So I think you will see some more transactions that are large. There is no doubt that those discussions are taking place right now. And I think the boardrooms and chief executives are feeling more comfortable about an economic outlook and a pricing that they can effectively act on. So I think next year should be reasonable. And the other side of it will obviously be an IPO market whose opening, I think, continues to get delayed.
Citi's Institutional Clients Group Chairman Leon Calvaria there with Bloomberg Shanali Barsak. Well, coming up, we get the latest when it comes to COP28 in Dubai. Delegates are wrangling over a deal to cut fossil fuel consumption. A climate diplomacy expert joins us next. This is Bloomberg.
You're watching Daybreak Asia. A draft deal at the COP28 climate talks in Dubai calls on countries to cut their consumption and production of fossil fuels. If adopted, the agreement would be the first to specifically call for reduced use of all fossil fuels, including oil and gas. But many countries believe the deal doesn't go nearly far enough, falling short of a complete phase-out and offering loopholes and opt-outs. For more on this, let's bring in Bloomberg NEF Head of APAC Research, Ali Izadi. Ali, so what's your assessment of the draft communique?
So certainly the language being used is a bit weaker than the earlier drafts that had included the phrase around the need for phase out of fossil fuels. At the same time, this is the first time that we actually have language explicitly calling for reduction in production and consumptions of fossil fuels. So we have made progress. At the same time, of course, the progress is not as much as what some stakeholders, such as the European Union, as well as small island developing nations, such as Marshall Islands, were calling for. So one step forwards, some would argue that 2 steps backwards.
How much do we need to reduce consumption of fossil fuels realistically to be able to meet Paris Agreement goals?
So the good news is for coal, we expect that we're already at about peak consumption. In our Paris-aligned net zero scenario, by 2050, we have to make sure that consumption is reduced by about 68% relative to 2022 levels. For oil, we would have to reduce consumption by about 75% relative to 22 levels, and need to make sure that peak oil consumption happens by around 2024. And for gas, we first need to make sure that consumption doesn't go back up to pre-pandemic levels. So we have to make sure that the peak happened back in 2019, and then we have to reduce consumption by 2050 by about 50% relative to 2022 levels. We have the technologies needed to manage the trajectory. We just have to make sure that we accelerate the deployment of these technologies.
So Ali, overall, how successful would you say this year's COP has been?
So at BNEF pre-COP, we did a deep dive into analyzing all the key 10 areas that were up for negotiation. And our pre-COP assessment, we gave it a score of 3.6 out of 10. Then we saw a little bit more momentum for progress, particularly when it came to loss and damage and the initial language around fossil fuel phase out. So we increased the score. Of course, we have to see what happens today to give the final score. My own personal opinion would be that we have had a relatively successful COP, recognizing that we've had some of the very first initiatives this time around. For example, this was the first time we had health ministers involved to discuss the negative impact of climate change on human health. We also saw a lot of new ground being broken at Dubai around the negative impacts on food systems. So really good progress on these new areas. Ultimately, we have to recognize that there are imperfections in a process requiring unanimous consent from 198 countries, which have very different sociopolitical circumstances. Recognizing this, I would still consider it a success.
Bloomberg NEF Head of APAC Research, Ali Izadi there. Let's get some more perspective on this climate conference, the impasse that seems to be taking place at the moment over this draft communique. Our next guest, who attended COP28 in Dubai this year, is with us. Rachel Kite is the co-chair of the Voluntary Carbon Markets Integrative Initiative. Rachel, great to have you with us. So I guess I will start off where we left off the conversation with Ali. Do you consider COP28 to be a success? How would you rate this year's summit?
A summit in 2 halves, and we have to remember that the text that Ali was discussing and that is before the delegates at the moment is not agreed yet. And so in these kinds of multilateral negotiations, nothing's agreed until everything's agreed. So there's still hours of wrangling over the details and the precise use of words. But at the front end of COP, there was a sort of 72 hours of extraordinary sort of tsunami of announcements, one after the the other. And it's true that the UAE has broken through the duality of public money from the north, the global north, has to flow to those who require it and need it in the global south. And it's sort of by the UAE putting new capital on the table, new financial innovation on the table, I think the conversation around finance shifted a little bit. But at the end of the day, what delegates were talking about was a report that they have all authored that said that we are not on track. And the text before delegates right now does not put us back on track. And I think that therein is the problem, that we've made progress, but I think until we're closer to being on track to really wrestle with global heating, I don't think we could call it a success.
No, and in fact, we heard from Chris Bowen, the Australian Energy and Climate Minister, speaking on behalf of the umbrella nations, including the US and UK, Norway and Canada, saying that, they could not, as the draft communique and wording stands, sign this on behalf of the smaller nations, right, that are sort of pleading for more action. This has been called by some as basically a surrender note. Is it possible to find middle ground to progress this at all?
Yes, they'll find middle ground, and I think it must sound very esoteric to the layperson, but the argument is over verbs. Are we just noting a report that says that things are really bad, or are we encouraging and urging each other to act more? So that's kind of where the discussion is now. So there will be discussions around the exact framing of the language of production and consumption of fossil fuels, but there will also be a lot of things that get pushed to the next round of negotiations in Baku, including issues around some of the details of how carbon markets can work, some of the detail about what the global goal for adaptation is. They have agreed, they stand the chance to agree that there should be a goal on adaptation, not just on mitigation, but the exact details of that still need to be worked out. So there's an awful lot of detail that is being pushed to sort of technocrats in the year to come.
When it comes to directly calling out the burning of fossil fuels, do you think that effort, given that there were some 80 countries at one point that had already supported using that wording, do you think that's been made complicated by the hosting of COP28 in Dubai and the proximity to these oil nations?
Not necessarily. I and others commented in the first half of this year that because the UAE's extraordinary progress over the last few decades was in large part due to its wealth from fossil fuels, that it understood the industry. It also understands the renewable energy industry, and so it was poised as potentially a power that could bring people to the table. But it's been quite clear, including a letter signed by the OPEC Secretary General, that within the oil-producing countries, there's been a significant pushback against the likelihood of agreeing clear language on production, consumption, or the phase-out of fossil fuels. And there's been lots of sort of negotiation around whether this should be abated or unabated, whether or not we're going to finance, continued production, but then we're going to capture and store all of those emissions. Are we talking about fossil fuels themselves, or are we talking about the emissions that come from them? All of this sort of diplomatic shenanigans really flying in the face of what the science is saying, and what especially the most vulnerable nations are saying, which is this phase out has to happen really quickly. We need to reduce emissions by 45% by 2030.
Rachel, are you optimistic that we're going to get there? You've written about and spoken about the fact that we're basically running out of buffer, running out of budget really quickly, that emissions need to come down faster, that the energy transition needs to come in sooner, that we need to be operating at a much bigger scale and investment. Can all of that come together?
Well, I think the investment, the trebling of the investment in renewable energy and the doubling in energy efficiency, which the vast majority of countries at COP28 have agreed to, is a good thing. The money is there. I mean, helping that money flow, especially into emerging markets, developing economies, is essential. And so, as Bloomberg, NEF, and others who analyse what's going on in the energy sector note, we can always outperform the best estimates of how quickly the green economy can grow. But while that grows, we have to phase out emissions. And I'm hopeful. I don't think I'm an optimist.
Rachel, really great to have you with us. Rachel Card, co-chair of the Voluntary Carbon Markets Integrity Initiative. Shery.
And Heidi, we are getting breaking news out of Japan. We are getting the producer price index numbers coming in at year-on-year growth of 0.3% for the month of November, which is beating economists' expectations of growth of only 0.1%. However, this is a slowdown from the previous month of 0.8% growth, which was already at the weakest level in over 2 years for the month of October. Producer prices have continued to decelerate. What that means is that really gives more support to the Bank of Japan's view that inflation is cooling down, and input prices gaining just below that BOJ's 2% target is not really boding well for expectations that we can see inflation be pushed up sustainably. When it comes to the month-on-month number, is meeting expectations at 0.2% growth for the month of November. We have more to come. This is Bloomberg. Welcome back. Bloomberg Intelligence sees the dominance of ETFs growing, with new entrants set to erode the market share of the sector's big three. Those would be BlackRock, Vanguard, and State Street. For more on the outlook for ETFs in 2024, let's bring in Bloomberg Intelligence analyst Rebecca Sin. Rebecca, so what other regions could be of interest in 2024 when it comes to the dominance of ETFs?
I think in Asia Pacific, there's really 5 regions that we're looking at. One is Japan. We expect that Bank of Japan, they will purchase less ETFs in 2024. If we look at 2023, it's a record year for them. They only purchased ETF 3 times. And with Governor Ueda, we expect that this trend will continue in 2024. We may even see no ETF purchase, which is where he would ideally like to be. So in Japan, we're going to expect more organic growth coming from the market. The Japanese dollar is relatively cheap relative to the US dollar at the moment, and we're seeing a lot of foreign investors invest into Japan. Japan is one of the leading regions with returns that have done very well. Topics, Nikkei 225 has all performed, and Japan launched for the first time ever active ETFs in September this year, and so we expect that active ETFs will be one of the big trends that will help push the Japanese market. The other market that we expect to do well is China. China has seen a lot of thematics ETFs this year, and themes such as AI and tech has all rose. In Q1 of this year, it rose 50%, and so we expect that themes to continue to do well. The CSRC has been very supportive of the ETF landscape. They've made a lot of changes. For instance, they've reduced their approval time from 6 months to 3, and in China, they've really tried to speed up the ETF approval process. And so that's why they have so many ETFs. And we've seen China launch one of the most ETFs this year. Another region that we expect to see a lot of growth this year is India. India has a population, more than half of their population is under the age of 30, and they have been very progressive towards ETFs. And so this fund market is currently very small. They only have about 30 billion in assets, but we could really see them becoming a top 5 player in Asia Pacific. And lastly, the region that we expect to see a lot of growth is Taiwan. Taiwan has just surpassed Australia in terms of assets under management. They now rank 3rd in Asia Pacific with more than 100 billion of assets, and we expect the trend of dividend and income ETFs to continue very well next year.
Bloomberg Intelligence ETF analyst Rebecca Sim. We do have the start of trading in Seoul and Tokyo next. This is Bloomberg.
This is Daybreak Asia. We're counting down to Asia's major market opens as investors brace for big central bank decisions this week, not to mention plenty of eco data. Markets were pretty muted and marginally higher in the Wall Street session, Heidi, but really we're awaiting that CPI number here in the U.S. to be followed by the FOMC decision as well.
Yeah, you're not expecting a lot of big bets at this point, right? Key data, key decisions, maybe not a pivot, but certainly looking for that signalling from global central banks as to when we might see the start of rate cuts, and also looking for signalling out of the Bank of Japan going into next week too.
Yeah, I mean, there's been so much speculation about where the BOJ is going that really the volatility in the Japanese yen has been incredible. We had that strength last week. We saw that weakness this week as well. And take a look at how we're coming online. The yen holding at that 146 level against the U.S. dollar. As we had seen it extend losses against the U.S. dollar in the New York session. Of course, that debate, the last week's rally had gone too far. And sources telling Bloomberg that BOJ officials see little need to rush into scrapping negative rates this month. Of course, we are headed towards a BOJ decision next week as well. So you are seeing gains for the Nikkei for a second consecutive session, up 1%. And we're seeing the Japanese 10-year JGB yield holding at that 0.77%. This following some producer price numbers that we saw earlier, surprising to the upside. November growth of 0.3% year on year. The estimate was only for 0.1%, but suffice it to say that we're seeing producer prices decelerating, and this really supporting the BOJ's view that inflation is cooling. Take a look at the Kospi, up 0.4% at the open. It was little changed in the previous session. Of course, we have seen some more positive data coming out of South Korea, especially when it comes to those trade numbers. At the moment, the Korean won holding at that 13.15 level. So we're seeing a little bit more strength after we saw it fall in the previous session, given, of course, the caution around the Fed's policy decision later in the week, Heidi.
Yeah, take a look at what we're seeing when it comes to trading here in Australia. We did hear from RBA Governor Michelle Bullock a little bit earlier, Sherry, really saying that it has been that tough juggle between keeping labour market gains and also clamping down on inflation, pushing back on, the idea that perhaps the RBA is behind the rest of the world in its inflation fight, and sounding quite optimistic going into 2024 as well. We are seeing it is a pretty flat session when it comes to trading here in Sydney. We're up at just about 0.2% there. If you take a look at the breakdown in sectors, there's not that much conviction. If you look at some of the gainers versus the weaker segments, energy is one of the areas where we're seeing some weakness. Tech seeing some of the strongest gains, along with consumer stocks, I should say, and healthcare as well. But none of those are really higher than 1% at this point. We're also seeing really not much of a move when it comes to yields here in Australia or New Zealand after investors really did shy away from that 3-month bill auction for Treasuries. Yields climbing a little bit amidst those US auctions, seeing pretty lackluster demand overnight there as well. Demand, though, for that 10-year still looking pretty resilient when it comes to Treasuries, at least, but a lot of sort of action away from the main fray as we wait for the Fed and some of these other major central banks this week as well. That 60-hour window of power for central banks is what we're setting up for. And our next guest sees Asian equities rising next year with a forecast of double-digit returns reinforced by favourable valuations and strong high-teen earnings growth. Kelvin Tay is Regional CIO at UBS Global Wealth Management. Kelvin, great to have you as always, particularly as we look into the last few weeks, whether or not we're set up for a Santa Claus rally. But I guess more importantly for investors is that you're pretty positive on the region as we head into the new year.
Yeah, absolutely. And that's largely because of the fact that valuations in Asian equities are a lot cheaper. And on top of that, we do expect the dollar to actually weaken next year. And the strength of the dollar has been one of the main reasons why Asian equities and Asian assets in general have actually underperformed this year. So in the year ahead, we do expect the euro dollar to trade towards 112. We expect US yields to actually come off to below 4%, closer to the 3.8, 3.5% level. And that in turn should be a pretty strong catalyst for Asian assets going into 2024.
How much upside do you see for China? Because that's really the wild card, isn't it? Obviously, the Central Economic Work Conference is taking place. Do you think stronger signs of fiscal support, stronger monetary policy support, maybe will finally see a staged turnaround for Chinese equities?
Yeah, well, we do think that the Chinese economy has actually sort of like bottomed out, but I think a strong recovery is not likely to happen in the next 3 months or in the short term, largely because of the fact that fiscal and monetary stimulus is still pretty much on a very light side. We don't see a lot of heavy stimulus coming through, and for that reason, I don't think the Chinese economy is going to actually stage a very strong recovery from here. More importantly, for Chinese equities to perform, the stock market to perform, the property market needs to actually recover, and thus far, the signs of a recovery in the property market has actually been very, very weak. You know, the SOE developers are doing well, but the privately owned developers are not doing as well. We do need that to actually recover before sentiment can actually become more positive where Chinese equities are concerned.
I'm looking at your themes for next year, and it's quite an interesting combination, right? Across the region, you're still looking at these, blue chips, essentially. What are some of the key themes that you're focusing on? And also geographically, given some of these markets like Japan and obviously India is the other one, have been the market darlings of this year.
Yeah, I mean, we like to focus on quality. We think that blue chip companies with strong balance sheets, good generative cash flows are the ones to actually look out for. Next year, we do expect rates to actually start coming off, but we're not as aggressive as the market in expecting rates to come off very, very sharply. We do expect rates in the US to come off by twice next year, and therefore that in turn should actually be quite positive for assets as a whole. But where the BOJ is concerned, we certainly don't expect them to actually hike anytime soon or to reverse the negative interest rate policy, because I think, as you rightly pointed out earlier, growth is still quite anemic in Japan. The latest inflation numbers are not that particularly strong, and we don't think that the BOJ will risk, the once in 20 years chance of inflation actually coming back up to about 2%. I don't think they will risk that by actually hiking too early. I think they're likely to be a lot more cautious than that. So I think as a result of that, we do think that where the Japanese equities are concerned, the Japanese banks are the ones that you should actually be looking out for, because of the fact that if the 10-year yields rise to 1% and if the 30-year yields go up to about 1.5 to 1.8%, there could perhaps be a lot more buying of these bond yields, of these bonds from the local pension funds and retirement funds.
How do you play AI? I should say. How do you play AI going into next year, given how much of a run-up and perhaps even over-exuberance we've already seen with some of the big names, particularly in the US?
Yeah, we prefer to play AI via the internet and software sector, actually, because we do think that where the early cyclicals of the tech sector is concerned, particularly with regards to the semiconductors, most of the rally has actually been done, and the stocks there are actually looking a little bit pricey. So we do think that for the tech sector, which has actually been filled by the this very strong enthusiasm for AI stocks, we do think that should actually be played out better in the internet and the software sector. So basically, companies that are actually not in the hardware space are supplying to the AI companies, we do think that the software side has better operating margins as well.
As you've talked about in the Asia outlook, this kind of new paradigm also involves perhaps new risks that haven't faced Asia before we've gotten to this point. What do you see as being the key risks, that we should be talking about for next year?
Yeah. I think the risk is if inflation does not come out as quickly as the market actually expects. As you know, the market is actually pretty aggressive in trying to price the rate cuts for 2024, and I think the market might be disappointed in the first couple of quarters where that is concerned, and that in turn should actually see a pretty strong rally on the US dollar, because I think the US dollar over the short term has actually weakened too much. At one stage it was almost at 110 against the euro. So I think any pullback where the euro dollar is concerned is likely to be negative for the Asian markets as a whole. But then again, we do think that if that happens in the first quarter or second quarter of next year, that should be a very good time for investors to actually pick up on the Asian assets as well, because we do think that where the second quarter is where the second half of the year is concerned, that the Federal Reserve will probably have to cut rates twice, and that in turn will likely be pretty positive for the Asian assets, given the inverse correlation between the dollar and the Asian asset space.
What do you see in terms of growth across private markets and private credit in Asia? We just saw Goldman's doubling the size of their unit to take advantage of obviously what they see as being a pretty bullish outlook for that space. Do you think that changes once we have a change in the monetary policy environment?
No, I think that's the start of a longer-term trend, largely because of the fact that there are a lot more family offices opening up in Asia, and the family offices are more are more sophisticated in their investment outlook, and I think the private alternative space is a space that a lot of them are actually particularly keen on. And we do know that for a fact that the private investment space, if utilized properly, if invested properly, can actually reduce your risk, the volatility of the portfolios. And I think that's something that's very, very key for a lot of these family offices. And increasingly, a lot of them are actually adopting this endowment investment approach, where you have not just bonds and equities, but you have quite a strong allocation towards the private equity, private debt space as well, to reduce the risk volatility of the portfolios. So I do think that that's not a flash in the pan, but it's the start of a longer-term trend with regards to investing in the private alternative space.
Kelvin, always great to chat with you, and have a great rest of the year. Kelvin Tay, Regional CIO at UBS Global Wealth Management there in Singapore. Well, still ahead, the British Chamber of Commerce in China has a new report on business sentiment. We'll be digging into those findings, whether we've seen an improvement in sentiment. Chamber Chair Julian Fisher will be along with us. Plus the details of Goldman Sachs' reshuffle of its senior executives across that private credit unit, as it's seeking to double the size of the $110 billion business. This is Bloomberg.
Watching Daybreak Asia, Chinese President Xi Jinping and other top leaders have reportedly begun their annual economic work conference that will set the nation's policy agenda for 2024. Expectations are high for an ambitious growth goal to shore up investor confidence. Our Greater China Senior Executive Editor John Liu joins us now from Beijing. So John, how important is this Central Economic Work Conference in setting the economic plans for China for the year ahead, and what are we expecting?
So I think this meeting could be key for China's ability to turn around the economy. And I think top of that list is the GDP target for 2024. It's not just a target, it communicates priorities from Beijing to bureaucracies around the country. If we get a relatively high target, let's say 5%, just as we have for 2023, that is an ambitious target because the relative basic comparison of 2023 is going to be higher than it was in 2022. And so that means officials around the country, if they're going to meet that target, are going to have to work harder. They're going to have to be more ambitious. They're going to need to try to do more and new things to try to get the economy to get to 5%. It's a powerful way for the central government to communicate to the localities that this is the priority for 2024.
We're also hearing from the US Commerce Secretary talking about the strongest action when it comes to the chip breakthroughs that we've seen. Clearly, this could be a setback when it comes to the broader economy too.
So semiconductors has been the most important choke point that the U.S. has had when it comes to its relationship with China. China has, before all of these sanctions, depended on Taiwan, Korea, the Netherlands, the United States for the technology used to produce the chips and the chips themselves. And now that that's been cut off, we've seen companies like Huawei take a substantial hit. Huawei used to sell more mobile phones than Apple did, and now that business has essentially been decimated. And so when it comes to continuing to limit Chinese access to technology, that is going to be the point of focus for Washington, and is going to be the thing that China, that Xi Jinping wants to overcome the most.
And with these ongoing tensions, we're now seeing President Xi Jinping making his first visit to Vietnam in 6 years. How significant is this?
So I think it's important to note that Joe Biden just visited Vietnam a few months ago. And so this is a country in Southeast Asia that's trying to strike this balance between the United States and China. China is its largest trading partner, but it's a rocky relationship. They have competing claims in the South China Sea. Vietnam and China fought a war in the late 1970s. And so there are security concerns on both sides. Vietnam has tried to use the United States as a counterbalance to China. And China, with this visit by Xi Jinping, is trying to make sure that Vietnam does not get too close to Washington.
Our Greater China Senior Executive Editor John Liu there with the latest on China. As we, of course, were looking ahead to the start of trade there. Stocks staged a sharp recovery on Monday afternoon with the CSI 300 reversing all of its 1.6% loss to close 0.6% higher. That coincided with a jump in trading activity for an ETF tracking state-owned shares, which investors follow for signs of state buying. Chinese shares missed out on a global equities rally last month with a recent Politburo meeting disappointing traders. Meanwhile, China's smallest and most volatile stocks have become a magnet for investors keen to amplify returns. The segment has become the lone gainer in Chinese equities this quarter. Let's get more from our Asia stocks reporter Jeannie Yu. Jeannie, of course, we have seen that confidence slump when it comes to Chinese assets. So what's going on in this sector alone?
Yeah, it's kind of like a very bizarre to a lot of investors, to be honest. This market actually, it even headed into bull market this year when everything else in China have been plunging. I think one of the key things is that the policymakers, they have really vowed support for the small and medium caps in China, which like all the components on the Beijing Stock Exchange are all those small names. I guess the second key thing, interesting fact is this is actually like a baby for Xi Jinping, the Beijing Stock Exchange. And when Xi voiced out the support for the Beijing Stock Exchange a few weeks ago, all those stocks got really big retail money inflows into some of those names. I think there is obviously a kind of policy-driven rally there. So that's why we've seen the index actually rally more than 20% this year, which is like a far long rallier versus other decliners on both the CSI 300 index and also the Chinex index.
Jeannie, we're also waiting for the sort of outcome when it comes to the Central Economic Work Conference, the GDP target, and what that kind of tells us about levels of confidence and policy support. What are investors hoping to see from that, and could it kind of help support finally a turnaround for the broader equity market in China?
Yeah, so far we are still waiting, for the key takeaway from the conference, which is gonna end on Tuesday. But the things we are hearing is that the Chinese government they tend to set the growth target at about 5%, which is not really surprising because this is what investors has been expecting. I guess the key thing they're still watching is how they're gonna frame their wording on the policy over the property market. This is one of the key things. I guess the other thing is how strong the physical support can be, for next year, because earlier we've seen, shares plunging yesterday and also on Friday because part of the reason is that investors don't see the assurance that Beijing is going to really launch a big stimulus support for both the market and also the real economy. I guess this is one of the key overhang for the market at this moment. So hopefully we can get some key takeaways from the Central Economic Work Conference, and then that's gonna help investors to remove some of the overhangs in the market, and then we have better idea on how much the index can go, either upward or downward at this moment.
Our Asia stocks reporter Jeannie Yu there with what to expect in the Chinese markets as we look ahead To trading across Asia, we'll be watching chip stocks after the Philadelphia Semiconductor Index rose to the highest level since January of 2022. We had the likes of chip makers like Intel and Broadcom outperforming and sending the Nasdaq 100 higher. Take a look at software makers that we'll be watching across Asia, given that Oracle just reported cloud sales growth slowing for a second straight quarter. So that disappointment when it comes to cloud revenue growth will really be felt across software makers across Asia. Also, we'll be watching those crypto stocks across Japan and South Korea. Bitcoin is stabilizing a little bit at the moment, but this after the currency dropped below $41,000 at one point, finishing the day in the Wall Street session with the largest decline in 4 months. And remember, this is following a more than 150% rally this year already. So with the latest drops, we saw large liquidations of bullish bets. So that's sent really the crypto market into turmoil, Heidi.
Yeah, we are getting, Shery, a little bit of an update when it comes to this Alphabet legal battle with Epic Games. Alphabet has lost their Google Play antitrust fight with Epic Games, and Google and Epic Games have been facing off in San Francisco, in a San Francisco court, I should say, as their app antitrust trial was nearing an end. We're now hearing that Alphabet has lost that trial to Epic Games. A federal jury had to be really convinced in San Francisco to reject antitrust claims by the Fortnite game maker Epic Games in the case that potentially is seen as a threat to Google's App Store and transaction fees that are imposed on Android app developers. We did hear that lawyers for both Alphabet, Google and Epic Games making those statements after more than a month of this trial in the lawsuit. Epic Games had alleged that Alphabet used billions to bribe and block its Android partners and app developers from using alternatives to its lucrative Play Store. So we'll bring you more details on that as it gets to us, but much more to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. Citi's Institutional Clients Group chairman says the environment for M&As should start to get better in 2024 after a very muted year. Leon Calvaria told us more about the state of investor appetite for deals.
The investor appetite is there, absolutely. They want to see the strategic rationale. They want to understand the time frame to close from a regulatory standpoint, because obviously if it takes 2 years, they have to factor that in from a present value standpoint. And then they want to see what the value enhancement is. So the investor reaction, I think, will continue to be something that everyone focuses in on. But so far, strategic transactions have done fine. And the issue has simply been long-term regulatory impact and how long will it take and what will be the legal issues to get from here to there. That's unchanged.
What about industry here? Because the other big elephant in the room we have not talked about is Occidental, Crown Rock, $10.8 billion deal. You're starting to watch mega deals back in the market. 2 of the top 3 deals this year so far have been mega deals in the energy industry.
Correct.
Is that what's going to drive M&A into 2024?
Well, I think the environment for M&A should start to get better here. We've obviously had a very muted year. It's been muted because of the uncertainty on the economy, uncertainty on interest rates, and uncertainty from a regulatory standpoint. those hurdles are starting to go away. But, you know, you still have a 10-year that has not yet gone down. It's not broken 4%. So financing remains somewhat expensive if people have to do it. But on the other hand, the equity markets, from my standpoint, are at highs. So the use of equity becomes very, very attractive. So I think you will see some more transactions that are large. There is no doubt that those discussions are taking place right now. And I think the boardrooms and chief executives are feeling more comfortable about an economic outlook and a pricing that they can effectively act on. So I think next year should be reasonable. And the other side of it will obviously be an IPO market whose opening, I think, continues to get delayed.
Citi's Institutional Clients Group Chairman Leon Kovaria there with Bloomberg Shanali Balsac. Taking a look at European futures opening up the minute. Of course, it is a big week when it comes to central banks more broadly. That 60-hour window of power, if you will, for those decisions. But this is what we're seeing when it comes to the start of trading in the future session for Euro Stoxx 50 futures. We're seeing a little bit of upside there. Potentially, we could see that year-end rally being added to for German DAX futures up by about 1/10%. And we are, of course, seeing European stocks holding near their highest since February 2022. It is, as I said, a week loaded with central bank risk, though, as well as key eco data. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
And we're seeing both stocks and the Japanese currency supported at the moment, with the yen holding at that 145.93 level against the greenback. We've seen a lot of volatility in the Japanese currency, all to do with speculation about what the BOJ will do next. Bloomberg's been told Bank of Japan officials see little need to rush into scrapping the world's last negative interest rate when they meet next week. For more, let's bring in our Japan economy and government editor, Paul Jackson. Paul, is that setting us up for basically no change next week?
Yes, I think it is setting us up for no change next week. But let's be clear about this. The end of negative interest rates in Japan is nigh. It is coming, but we think it's going to be next year rather than this month. From what we're hearing, BOJ officials see no need to rush this decision. Let's face it, they've spent more than a decade with this extraordinary stimulus program. It would seem a bit odd to rush it right at the last minute. Now, if you look at the logic of what they're saying, that we've had kind of bad inflation in Japan, and what they're wanting is good inflation that is supported by wages. They're saying they want to see more evidence that that wage growth is there and in place. We have these negotiations for between unions and companies with results to be out in mid-March. So, the logic suggests that the best timing for this change at the BOJ would be April. That's also a month when it releases forecasts. It also releases forecasts in January and July, so they are other possibilities. But I think April should be the main case, with a risk scenario of an early move in January.
Paul, how much volatility could we see this create across global markets, depending on the timing?
Well, I think there's always going to be a lot of volatility heading up to each of these meetings from this point. I think markets are going to be on edge at each meeting, no matter what intel is out there. The BOJ has surprised in December, and it did again in July this year. So the concept of kind of taking advantage of markets' momentary kind of expectations that nothing's going to happen, that's something the BOJ has used to its benefit. But I think that's mainly been on tweaking the YCC end of its complicated stimulus program. I think something more hardcore, like the short-term interest rate, this negative interest rate, it's the last one amongst major global banks globally. I think they're going to be more cautious about this one, about signalling it. And don't forget that Governor Ueda is the godfather of forward guidance at the BOJ. He's the one who originally brought it on board.
Paul, what is the economic data out of Japan telling us? Because we got the producer price numbers earlier today, surprising to the upside, but we're still talking about those numbers easing to the lowest or weakest since 2021. So is this just giving more support to the BOJ's assumption that inflation is in fact cooling?
Yes, I think it is. And let's face it, we just had economic data for the economy showing the biggest contraction since the pandemic over the summer. So, really, would a central bank want to raise its interest rates after so long, just when, the most recent data shows the economy's in reverse, going backwards? If they got the decision wrong, that would be a bad look. History would not judge it well. What, you raised rates when the economy was shrinking? What?
Bloomberg's Japan economy and government editor Paul Jackson there. This is what we're watching when it comes to broader markets trading at the moment, and unsurprisingly, we're not seeing a whole lot of risk-taking across the board. Of course, we do have really an extremely busy week setting up ahead of us, not just when it comes to central banks, but of course the key data points as well. US inflation is really one of them. We are seeing some muted gains. We've seen Japanese stocks up about 0.7%. We're seeing the Kospi putting on just about 0.5%. Here in Australia, some of those tech names are leading the gains when it comes to this mild rally that we're also seeing. We do have potentially a pretty strong opening for Hong Kong when trading gets underway there, but largely a pretty benign start to the trading week. For Australia, we're also digesting a bit of data really showing that at this point in the rate hike cycle, confidence is starting to get hit by both households as well as broader consumers and businesses as well. Shery, that business confidence number plunging to an 11-year low. Consumer sentiment, as we saw earlier, still holding in pessimistic territory.
Yeah, talking about pessimistic territory, really, Chinese assets have taken a beating, right, recently, but we are looking forward to the open of trading in the mainland markets and Hong Kong. British businesses in China, though, responding positively to what seems to be greater engagement from the Chinese government. That's according to a survey conducted by the British Chamber of Commerce in China and set to be released in a few hours. Let's get insights from Julian Fisher, chair of the British Chamber of Commerce in China. Thank you so much for joining us today. So how much of that positive sentiment is actually translating into business decisions?
I think at the moment we're seeing a real mixed landscape with investment. There seems to be a lot less speculation and a lot more pragmatism. The top two reasons that we saw for investment were around aligning with government strategy, but also more demand for product and services, which I think is a real improvement on previous years where it's been a lot of investment because of market potential.
Your latest surveys say that businesses are trying to increase spending on key areas of R&D. Which industries are they interested in?
So particularly we're seeing investment in healthcare and in energy. And I think that kind of covers with a lot of the report where it's aligning with government initiatives here. Obviously, the government is putting a lot of investment itself into healthcare and also really, really wants to work on energy security as well. So yeah, those are two real bright spots for British business in China.
When we're talking about these businesses in China, how big companies are we talking about? Are we talking about larger caps or also smaller, medium-sized businesses? Because we know that usually those smaller companies take the brunt of any slowdown in the broader economy.
Yeah, so that's absolutely reflected. We run this survey every year, and this was the biggest response rate that we've ever had. So we had about 301 British businesses across all sectors, all sizes. That includes all of the, FTSE 100, but also a lot of SMEs as well. And one thing that we see is that SMEs are struggling. Over 50% of them have not hit the revenue levels of pre-pandemic, whereas we're seeing with MNCs that they are doing far better than they were in general than they were pre-pandemic. So it's absolutely a split between small business and multinationals.
What is the biggest topic of worry for your membership? Is it geopolitical concerns, sort of internal policy changes that are not necessarily predictable, or is it the fact that the market itself, the economy, is still slowing?
So there's been a really dramatic shift for obvious reasons from last year. Last year, we saw record highs in pessimism, about 43% for all British businesses, and that really was just around COVID. Now what we're seeing is a lot different. We're seeing three major concerns. One is the Chinese economy. The second is geopolitics. That's China's relationship with the UK, with the US, increasing nationalism when it comes to purchasing. And then it's also around the global economy. So I think a real shift. And one thing that surprised us with the survey data this year was that 60% of British businesses said that it was more difficult doing business now. We conducted the survey in October, November, than it was last year in the depths of COVID. And I think that reflects that for businesses, last year there was uncertainty around operations. Now there's real uncertainty around revenue.
What would you encourage from the perspective of policy and I guess more overtures from the Chinese government to be able to win back that confidence?
So generally, I think one thing that was a bright spot, particularly from the Chinese government perspective in this survey, was that actually there was real positivity towards government action this year. And I think particularly towards the 24 points that are looking to encourage direct foreign investment. I think from a British Chamber standpoint and from our members too, when we released our position paper in May, we said there was conditional optimism. And I think that still stands. It's great that the 24 points are out. They cover a lot of the issues that we've been advocating for over the last couple of years. Now it's all about implementation.
What about regulatory concerns? Because we have seen, say, stricter laws around data flows. That's been really causing anxiety for broader foreign firms. Is that what you're feeling from your members as well?
Yeah, so for the first time this year, cybersecurity and data flows is the #1 concern across all businesses in terms of challenges of doing business. Number 2 was around the transparency of the business landscape, and number 3, enforcement of laws and regulations. And then for the first time ever, we had 2 new entrants into the top 5. One was about moving finances overseas, and one was about licensing. So these are all quite practical concerns for business, particularly around licenses. If businesses can't get appropriate licenses to operate, they're not going to do business here. So I think these are very simple areas for the Chinese government to address. The question is whether they have the will and the ability to across the country.
So for a while, especially during the depths of the COVID pandemic and the lockdowns in China, we have been asking business chambers about their members trying to perhaps move into other regions and build redundancies. Is that still part of the rhetoric among your members?
So certainly, I think one thing that we did see during COVID was that, previous to the pandemic, China was number 1 or number 2 in terms of priority for most British businesses that are operating in the country. That's definitely slipped to 3 or 4, and I think we can see the companies taking a risk. I don't think it's moving up the country necessarily, but it is, in many ways, just making sure that they are diversifying their risk across the region.
Julian, if you had to pinpoint to one concern next year, what would be the biggest challenge for these businesses in the country in 2024?
I think in many ways in China, everything comes from government. And I think they're going to be looking at what the Chinese government does in response to the economic slowdown here. But I think it's also going to be about, engaging with the UK government as well, because that really matters. And we're going into an election year in the UK. And I think there is some concern here among business that China may become a bit of a political football in the UK during that election year. So hopefully there'll be frequent visits. I think that's important just to show and normalize relations between the two countries. But yeah, I think we want certainty, as all business craves. The doubt, I think, is around responses to the downturn in the economy, but also just geopolitical relations.
Julian Fisher, Chair of the British Chamber of Commerce in China. Really great to have you with us. More to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. Goldman Sachs is reshuffling senior executives in its $110 billion private credit unit as it seeks to double the size of the business. Bloomberg's Sue Keenan joins us now with the latest. And Sue, we know that Goldman already has a relatively large private credit arm.
Yeah, and it's unique in that sense among peers to have such a large size, $110 billion, and now that they're seeking to double that, it literally dwarfs their closest rivals. So its head of asset and wealth management says what Goldman wants to do is take advantage of this. They think that it's the biggest opportunity set across the alternative space, private equity, and Goldman has long led other big banks such as JP Morgan, Citi, and Barclays, led them in this growing $1.6 trillion market. And their private credit arm dates back before the financial crisis in 2008. So its strategy has been to house the franchise within its asset management division. Greg Olafson is now going to be the global head of private credit, and he's being promoted from his role as co-president of alternative assets. James Reynolds becomes the bank's global head of direct lending, and Kevin Sterling becomes global head for investment grade private credit and asset finance. Now, you may recall there's been a lot of departures at the senior level at Goldman with a lot of other restructuring that's going on. So these are significant changes in an area of the bank that generates a major amount of revenue. Goldman's changes come as it seeks to really take advantage of their, the fact that they have the lead in this area. And it also comes at a time when rivals are now scrambling to respond what's being perceived all over Wall Street as a rise of this new asset class that completely competes with their leveraged finance business. So it's a situation of either get in or be, competed with, and Goldman clearly in the lead on this regard. They are all in.
Just one sign of the rise of this asset class is the growing trend that we're seeing across APAC.
Yeah, it is particularly strong. There's a statistic where 72% of investors in the APAC region plan to increase their allocations in private equity in the coming year. And that statistic comes from a survey from Caller Capital. Almost half of private market investors plan to increase their target allocation to the $1.6 trillion private credit market. And investors have been flocking this year with a host of banks and asset managers pouring capital and resources into this fast-growing industry. Private equity, it has a lot to do with higher interest rates, which play a role in boosting the yields on its floating rate products. The interest from Asian investors is being attributed to slow deployment last year, driven by portfolio reorganizations, regulations, and capital controls. And the survey also found that 45% of investors felt the current interest rate environment is now favorable for this private credit performance. Also, it found out 36% say the effects of higher interest rates on their private credit portfolios are yet to materialize. Private credit winning out. Back to you.
Bloomberg Sue Keenan there. Well, Morgan Stanley's chief U.S. equity strategist and CIO Mike Wilson says U.S. company earnings are likely to weaken in the fourth quarter before rebounding next year. He spoke with Bloomberg's Lisa Abramowitz on his stock predictions for 2024.
It's really more about the stock picking, which is really what this year has been about too. The average stock has not done particularly well. It's kind of been a strange year in that regard. Our earnings forecast for the average stock has turned out to be, dead right, and same thing for the average stock. And then we've had these, 10 or 20 or 30 stocks which have done extremely well, and they've done an incredible job of cost cutting in particular, which has driven the major average, the S&P 500 earnings up in a way that we did not project. And that has been the difference. And we think that that dynamic will probably persist next year, at least for the first two quarters, meaning smaller, lower quality businesses are going to continue to struggle. And then maybe by the second half of next year, when we see actually inflation bottom, ironically, that's when the earnings will come back. And I think that's been the trick. I mean, if you think about this year, inflation's been coming down, which usually is unequivocally good for bond yields. It's also good for disinflationary assets. It's not good for inflationary assets, which are basically small cap stocks and generally average stock. The average stock does better when inflation is actually accelerating. And I think that's been the trick this year. And most people got it wrong, quite frankly, because there were many people recommending, small cap stocks and financials and cyclical stocks, and this just don't work when inflation's coming down.
Mike, what you outlined, though, raises a question about the 4,500 target on the S&P at the end of next year. Is that assuming the big tech can't keep leading, that essentially there might be a recovery of some of the other stocks, the smaller caps, but that there will be at least some stasis for the big tech names that account for the lion's share of a lot of indexes?
Well, that's right. I mean, basically, this year has been all about multiple expansion, and this is in a year also when rates have gone up for most of the year until recently. So that's a combination that is unusual, as you know. So, our call at the beginning of this year was that rates were going to rates had normalized, quite frankly. They were going to continue to normalize, and then therefore multiples should normalize. So the real difference between our price target this year and what's transpired has been all multiple. We thought the market would close the year at 17 times earnings, which seems to be a fair multiple in an environment with 10-year yields north of 4% and some sort of level of risk premium. But instead, multiples are 19 and a half times. So all we're saying, Lisa, is that multiples will adjust this year. Earnings will be fine still for those large cap companies, but the multiple offset probably has them churning in place. And there will be some, obviously, that can continue to deliver better earnings growth, but it won't be all of them. It won't be as broad because that cost-cutting story isn't going to be as easy given the tougher comparisons on that front in 2024.
Morgan Stanley chief U.S. equity strategist and CIO Mike Wilson speaking with Bloomberg's Lisa Abramowitz. And the company also seeing another good year for emerging markets, but not without some surprises. Among them, that EM sovereign credit returns may hit zero again as U.S. Treasury yields rebound to 5% by the end of 2024. They expect EM hard currency bonds to return 14% next year, while local currency debt returns 8%. Heidi.
Shery, some of the top corporate stories we're tracking this hour. A jury in California has ruled that Google's mobile app store maintain a monopoly in the Android app distribution and payments market. The ruling could potentially jeopardize billions of dollars of revenue generated by its app store. The move also deals a blow to the tech giant in its antitrust battle with Epic Games, which sued Google 3 years ago. Microsoft is teaming up with labour unions to create an open dialogue on how AI will impact workers. Under the partnership, the tech giant will provide training on how artificial intelligence works and gather feedback from certain sectors. This marks the first formal collaboration on AI between the tech industry and unions, amid concerns it could displace workers. More to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. Guyana's president says oil majors are moving ahead with production plans in his country's waters despite an escalating border conflict with Venezuela. Irfan Ali told Bloomberg that companies operating in the Essequibo region will not be intimidated by Venezuela's threats. President Nicolas Maduro last week told ExxonMobil and others to leave the region within 3 months, raising the possibility of an armed confrontation.
But as it relates to Exxon and all the members of the consortium, they are moving ahead aggressively with their production plan. All the exploration in this region, Essequibo region, will continue. All our investments, both at the public and private level, will continue. There's absolutely no slowing down. There's absolutely no slope or no holding back in the investments that we have for Essequibo, as we have for the other 9 administrative regions and the other 2 counties of Guyana.
Occidental Petroleum has agreed to acquire Texas shale driller Crown Rock in a cash and stock deal valued at just over $10 billion. The transaction is expected to close in the first quarter of 2024, subject to regulatory approvals. The agreement comes as oil executives face pressure from investors to keep buybacks and dividends flowing, even as the North American shale sector matures and growth slows. Take a look at West Texas Intermediate right now, gaining a little bit of ground after rising in the New York session. We're seeing a little bit of steadying in the energy markets after 7 weeks of losses, the longest weekly losing streak in 5 years. We're looking ahead to the OPEC reports as well as the IEA. That's it from Daybreak Asia. Our markets coverage continues. Bloomberg Markets China Open is next.